One thing that's very interesting, amongst others, that Marshall's been talking about today is the divorce potentially between what we're seeing in the financial markets and what is going on in the real economy. You're talking about how the markets are in a sweet spot, but not necessarily the broader economy. I want to bring in another voice on this as well. Piers Curran is the head of trading at Amplify Trading as well. And correct me if I'm wrong, Piers, but this is something that, that you're talking about a little bit in your notes as well. W-shaped recovery, but we've already seen the W recovery in stocks, and there is a subtle difference.
There is a subtle difference. I mean, just looking purely at the stock markets, I mean, everybody's getting hung up on different letters, and I think it's not necessarily what people should be looking at. If you want a W, I think a W's there with the drop down to the lows in November, the retracement up to the end of 2008.
But this is the equity market you're
This is the
about.
equity markets, and people get hung up on what the recession, what the shape of recovery should be. I think they should pay attention to actually what's the market telling them, and the market's bullish. We're bullish for the next 6 months, and I don't think you should be too worried about letters.
So the seat's still warm from Anthony Gibbs, who was saying it's because of governments putting liquidity in. It is not because there is a renewed appetite out there in the markets.
Well, I disagree. I think that people overcompensated in terms of their cost cutting throughout the first half of this year. They were pricing in a depression. A depression is certainly not what happened. We got a fairly severe recession, which we're now coming out of the other side of. And I think there's some catching up to do on a corporate level. The labour costs are incredibly low. The inventory levels are at record lows, and they're very well leveraged for a pickup in economic activity, which I think, all the evidence is there to suggest that pickup in activity is happening.
Marshall?
Actually, we agree. Our U.S. Analysts say that in 2011, we expect the S&P 500 earnings to hit a record high. And for 2010, there are actually several sectors where consumer staples, healthcare, infotech, and utilities. We expect their earnings to be at a record high. They cut costs dramatically this year on the assumption that the world was going to end. Now the world didn't end, and in fact growth is picking up. Nothing extraordinary, but it's picking up.
All right, so you two agree. I have to take the other side. The fact remains is that there are huge structural problems in global economies. Certainly in the Western economies, you have massive unemployment, which we've all established is going to take years to budge. It's not going to move as quickly this time round, as you've already pointed out as well. Over in China as well, let's talk about that side of things if we're looking for them for the growth. If you took away the government-inspired GDP growth, it would be almost benign, the GDP in places such as China. It would be 1–2% perhaps, not the 8–9% that people are talking about now. There are a lot of issues which mean it's not going to see any demand for that inventory, that we're not going to see any demand for that very stable, low inflation workforce.
Yeah, I mean, I think you're talking about two different things here. I'm talking about the short-term view. In the next 6 months, we're bullish. I think the long-term view is a little bit less clear, and for the reasons you're making. The over-reliance of the US GDP on the consumer is a massive issue, and to counter that from Asia, I think the Chinese population, that's the direction they need to go in. They need to rely more on their consumer, get their consumer spending. I think that's the story for the next 2 years. I think before we go there, I think the action in the markets at the moment is so extreme that you actually need to focus in on the short term for now, and let's worry about the long term in 6 months.
Okay, all right, well, let's concentrate on that short term at the moment. You've made some points about PE ratios as well. It's a great debate we've been having, I've got to say, with various guests over the last few weeks or so, and you're in the camp very much, and obviously very clearly, that PE ratios are not an issue at these levels.
Yeah, I mean, I think that earnings are an artificially low level because of the fact that we thought there was going to be a depression. Okay, so if you value, the PE ratios on current earnings, yes, are looking a little bit inflated, but step back a minute. When this economy begins to pick up, as it is going to do, earnings will also rise, and then if you base these, if you do a PE ratio on 2011 projections, the PE ratios are very, very cheap. So
what is it?
It's around about 11 for the S&P.
As opposed to 20, which people are factoring in now. Let's drop it here for the moment, gents. I know we're going to come back into this. Becky, let's tell us what Sainsbury's have been saying.
Yes, so let's take a check. Sainsbury's has posted slower sales growth for the second quarter. Underlying revenue was up by 5.4% compared with a rise of 7.8% in the previous quarter. And the UK retailer expects market growth to further slow as food price inflation eases. Well, Piers Curran is head of trading at Amplify Capital and is still with us, obviously, because that was about 2 seconds ago that we just, thanked him for that last conversation.
Well, maybe our attention span of some of our viewers isn't quite what it should be. Maybe that's what the producer's saying.
I like to think our viewers are concentrating, engaged.
I was talking about the viewers.
Yeah.
Maybe they...
Yes, we've had Tesco yesterday as well, Sainsbury's today. When we spoke to the Tesco CFO yesterday, they seemed to be not optimistic, but a bit less pessimistic probably about how the UK consumer is going. Is it time yet, do you think, to breathe something of a sigh of relief about what's going on in the UK High Street?
Maybe it's a little bit early to say that. I think these guys want to be overcautious. They don't want to suggest that things are turning around very quickly, because if they don't hit numbers that they're suggesting, then obviously that's going to impact on their stock price. I think these guys are very cautious. I think there's a lot of kind of emotional scarring that's happened, you know, throughout the first half of this year with the collapse in the markets.
Let me jump in here. I think we're all insane. I think economists have gone mad. Measuring how well a consumer is doing in the current environment by how much they spend, their attitude to how much their future going to be spending, is absolutely bonkers. If, having gone through what we've all just gone through and are still going through, I would measure how strong the consumer is, and for that we can talk about electorate or the population, by how much they're saving. They're going to feel better about themselves the more money they've got in the bank, the less money they put on debt. Governments and economists seem obsessed by looking at people, whoa, they've got to spend more, they've got to spend more. We need a structural change to attitudes towards the consumer, and bearing in mind it's 70–80% of the economy on both sides of the Atlantic.
Well, actually, we're getting that. You're seeing the savings rate in America go soaring.
It's not soaring. It was 6% earlier, and the latest figures were 4.2%. It's come off.
That's because of the Cash for Clunkers program. A lot of people drew down their savings to buy a car.
Great, so we buy more cars. You're going to talk about cars in a bit. 700 odd cars per 1,000 people in the United States. And you're going to tell us later on that if the Chinese get up to those kind of levels, the world's a better place.
For car makers, yes. For oil producers.
Piers, you've got a final comment on the consumer?
I agree on the car situation in China, but that's a different story. The consumer, it's a long-term problem. That's the long-term view. It's going to be an issue. I think let's check out the next 6 months. These markets are going higher.
How much over the next 6 months?
At least 10%.
Piers, nice to see you today. Thanks very much indeed for joining us. Piers Curran, head of trading at Amplify Trading.